There's a retirement party happening in a conference room on the third floor of a building you've driven past 100 times. Fluorescent lights, sheet cake from the grocery store down the street. Two names on the banner. Leonard and Russell. Same company, same department, same title. 20 years side by side, $73,000 a year. They carpooled for 11 of those years, ate lunch at the same table. Watched the same football games on the break room television on Monday mornings. Russell is 62, Leonard is 63. They're both done. Russell has $91,000 in his retirement account. He's already running numbers in his head, wondering whether he should have waited another 3 years. Leonard has $1,400,000. He's not running numbers. He hasn't run numbers in years. Nobody in that conference room knows this. Nobody has ever known this. Not their manager, not their wives' friends, not the financial advisor Russell has been calling every quarter since 2012. The difference between these two men is not income, not inheritance, not a windfall, not a lucky stock pick, not a side business that took off. It's 7 habits, every single one of them invisible, every single one of them counterintuitive, and every single one of them available to anyone earning a regular American salary right now. You're about to see all 7, not as advice, not as tips, as the exact operating system that separated one man's retirement from another silently over 2 decades in a building with fluorescent lights and grocery store cake. The question isn't what Leonard did, it's why nobody, including Russell, ever saw it happening. Habit 1, they stopped trying to earn more. Russell spent 17 years optimizing his income. He negotiated every raise. He took the overtime shifts when they opened up in November and March. He switched departments twice, once in 2006, once in 2013, specifically because the move came with a pay bump. By year 12, Russell was earning $4,000 more per year than Leonard. $4,000. That's the gap Russell thought was the gap. Here's what actually happened. Every time Russell's income went up, his life went up with it. The apartment became a house. The house became a bigger house 12 minutes farther from the office. The sedan became an SUV. The SUV became a lease on something German with heated seats and a payment that lasted longer than the excitement of driving it. Each raise arrived with a feeling you earned this, and each feeling arrived with a purchase you deserve this, and each purchase arrived with a new monthly obligation that absorbed the raise entirely, sometimes before the first new paycheck even cleared. The SUV lease was $389 a month. The bigger house added $412 to the mortgage. The gym membership Russell never used but kept because canceling felt like giving up on himself $49. The streaming services, the upgraded phone plan, the lawn care company because the new yard was twice the size, none of these felt like mistakes. Every one of them felt like the natural next step for someone earning more. Russell wasn't careless. He was doing what 78% of American households do. He was converting income into lifestyle at a rate of almost exactly 1-to-1. Leonard got raises too. The same ones. Smaller sometimes because he never pushed for them, but Leonard had a habit that nobody in the building could see. Habit 2. They never upgraded their lifestyle after a raise. When Leonard's salary went from $58,000 to $63,000, nothing in his life changed. Same apartment for another 2 years, same car, same grocery store, the one on Maple, not the Whole Foods that opened on 9th. The difference, $5,000 a year, about $417 a month, went somewhere Russell never thought to look. It went into the machine. Not a special account, not a hedge fund, not a complicated strategy. Just the automatic transfer that Leonard had set up years earlier, adjusted upward by the exact amount of the raise every single time. Mechanically, without celebration, without discussion, without a single visible change in his daily routine. The pattern here is structural, not moral. Russell didn't fail because he was reckless. He failed because the economy is designed from the car dealership financing to the real estate ads to the Instagram algorithm to convert every dollar of new income into a new expense. That's the default setting. That's what happens when you do nothing different. Leonard didn't resist that pull through willpower. He removed the decision. He made it once every raise feeds the system and then never revisited it. The raise didn't feel like a raise. It felt like nothing. And feeling like nothing was the entire point. The rule: the gap between wealthy and comfortable isn't income. It's the distance between what you earn and what you need. Russell closed that distance every single time it appeared. Leonard let it widen silently, automatically, invisibly. By year 15, Leonard's capture rate, the percentage of his income flowing into the system instead of into lifestyle, was 31%. Russell's was 4, same salary, same parking lot, same coffee machine, every morning at 7:45. But if Leonard lived exactly like Russell on the surface, same neighborhood radius, same lunch in the break room, same shoes from the same store, how did nobody notice that one of them was quietly becoming a millionaire? Habit 3. They look like everyone else on their street. Leonard's house was 1,200 square feet, 3 bedrooms, built in 1987. The lawn was clean but never landscaped, no river rock, no ornamental grasses, no lighting along the walkway. The car in the driveway was paid off. The mailbox didn't have a camera doorbell. The kitchen had the same countertops it had when he bought the place. Russell's house was 2,200 square feet, 4 bedrooms, built in 2004 with a home equity line of credit attached to it that Russell used twice, once for the kitchen remodel in 2009, once for the deck in 2014. The kitchen remodel alone cost $19,000. The deck cost $11,000. From the street, Russell looked more successful. From a balance sheet, Leonard was worth 15 times more. This is not an accident. This is the third habit, operating exactly as designed. Visible wealth leaks. Here's how. Every upgrade you make that other people can see creates a new baseline, and baselines don't move backward. The new car creates an expectation of the next new car. The remodeled kitchen creates pressure to finish the bathroom. The neighborhood itself creates a standard of living that flexes upward but never downward. You can always add a deck, you can never unadd it. Leonard never entered that cycle. Not because he couldn't afford to, because he understood, maybe not consciously, maybe just instinctively over time, that the moment you signal success, the cost of maintaining that signal becomes permanent. And permanent costs are the silent enemy of compounding. Habit 4. They don't talk about money with anyone. In 20 years of carpooling, Russell never once heard Leonard mention a stock, a fund, an interest rate, or a financial goal. Not once. Not even during the crash in 2008, when every other person in the building was talking about their 401k like it was a family member in the hospital. Russell talked about money constantly, not in a flashy way, in the normal way that most Americans talk about money, complaining about taxes in April, mentioning the mortgage rate at lunch, wondering out loud whether the market was going to crash again before the election, break room commentary, parking lot conversation, the background noise of financial anxiety that sounds like small talk but functions as something else entirely. It functions as exposure. When Russell mentioned he was thinking about investing in his brother-in-law's restaurant, 3 coworkers had opinions. When he mentioned the equity line, someone suggested a contractor. When he said he was thinking about a rental property, a guy from accounting emailed him a listing that weekend. Every financial decision Russell made was filtered through other people's reactions, expectations, and enthusiasm. And other people's enthusiasm is almost never calibrated to your financial situation. It's calibrated to their own excitement about the idea. There's a compounding effect to exposure that nobody talks about. Every conversation Russell had about money created a social expectation. Once people knew he had the equity line, they expected him to use it. Once people knew he was into investing, they brought him ideas. Once he mentioned thinking about rental income, 3 different people sent him listings within a month. Russell didn't just make financial decisions publicly, he created a social infrastructure around himself that generated pressure to keep making more decisions faster, bigger, less carefully than the last. Leonard's decisions were filtered through nothing. Nobody knew, nobody weighed in, nobody created social pressure to spend, invest, diversify, or perform. His financial life existed in a vacuum, and that vacuum is where compounding does its best work. Silence about money isn't modesty, it's not embarrassment, it's a shield. It removes the single most powerful force that drives financial behavior in America, the opinions of the people standing next to you. Habit 5. They automated everything and stopped watching. In 1998, Leonard sat down at his kitchen table, the small one near the window, not the dining room table, and set up an automatic transfer. $412 a month, from checking to a low-cost index fund. He didn't pick stocks, he didn't study sectors, he didn't subscribe to a newsletter, or join an investment forum, or read a single book about beating the market. He set it and left. Russell, in that same year, opened a brokerage account with a firm he saw advertised during a football game. He picked individual stocks, 3 tech companies, a pharmaceutical, and an airline. He checked the portfolio during lunch breaks. He moved money between funds when the market dipped more than 2% in a week. He sold positions when headlines scared him. He bought back in, always a little late, when things stabilized. By 2008, 10 years in, both men hit the financial crisis at the same time. Leonard's account dropped 37% on paper. He didn't log in, he didn't sell, he didn't call anyone. The automatic transfer executed on the 15th of October, same as every other month, buying shares at the lowest prices of the decade. He didn't know this, he wasn't paying attention. Russell's account dropped 41%, not because the market hit him harder, but because he sold at the bottom. He watched the numbers fall for 3 weeks, read 4 articles about whether this was the next Great Depression, and on a Tuesday morning in October, he logged in and sold everything. Panic is a transaction, and transactions have costs. He sat in cash for 9 months. 9 months of watching the recovery happen on the same CNBC screen where he'd watched the crash. He bought back in after the market had already regained 14%. By the time his money was working again, Leonard's money had been buying cheap shares for 9 consecutive months without a single moment of hesitation. Here's the paradox. Attention is not the same as progress. The account that grows the most is the one nobody touches. The decisions that compound best are the ones that were made once and never revisited. Leonard's $412 a month adjusted upward with every raise, compounding at the historical average annual return of a broad market index over 22 years, produced $1,400,000. The exact number depends on timing, on which index, on which years the raises landed. But the order of magnitude is real, and the mechanism is ordinary enough to be invisible. Habit 7. They made the same boring decision every single month. $412. Then $450 after the first raise, then $490, then $520, adjusted upward, never adjusted downward, never paused, never redirected. For 264 consecutive months, no strategy pivot, no new asset class discovered at a dinner party, no exciting weekend spent researching cryptocurrency, no conversation about timing the top or hedging the bottom. The same decision, the same account, the same transfer date for 22 years. That number 264 months is the part that sounds boring when you say it out loud. And it is. It's supposed to be, because the excitement of a new strategy is almost always the sound of a compounding curve being reset to zero. Every time Russell found something new, a better fund, a smarter allocation, a friend's recommendation, he felt the buzz of making a smart move. And every time the math started over. Leonard never felt that buzz. Not once. And that absence of excitement is worth $1,400,000. What looks like stagnation is compounding in disguise. The first 10 years feel like nothing is happening. The next 5 feel like maybe something is working. The last 7 feel like the account has its own engine because it does. Russell changed strategies 4 times in 22 years. Each time he reset the clock. Each time the compounding curve restarted from the bottom. 4 resets over 2 decades. 4 times the math started over while Leonard's math kept running. Leonard never reset. That's not discipline, that's architecture. He built a system that didn't require discipline because it didn't require decisions. Habit 6. They said no to almost every opportunity. In 2005, Russell invested $12,000 in his brother-in-law's restaurant, a barbecue place off the highway with a good location and a strong first month. It closed in 2007. The $12,000 was gone. In 2011, Russell put $8,000 into a rental property with a college friend. Split the down payment, split the management. The tenant stopped paying after 14 months. The property sold at a loss 18 months after that. Russell's share of the loss came to $6,300. He also took a side consulting gig for 2 years, 2015 through 2017. It paid $900 a month, good money, but it consumed his Saturdays, compressed his Sundays, strained his marriage in ways that didn't fully heal until 2019, and lasted exactly long enough to fund the kitchen remodel that he financed through the equity line anyway. Leonard was offered the same opportunities, every one of them. The brother-in-law pitched him at Thanksgiving, the college friend called, the consulting offer went to both of them. Leonard said no every time, without explanation, without analysis, without counteroffer. Not because he studied the deals and found them lacking, not because he had superior financial knowledge, because he had a system that was already working quietly, automatically, month after month, and he understood something Russell never fully grasped. Every yes to something new is a no to the thing that's already compounding. Every dollar redirected to a restaurant or a rental or a side hustle is a dollar removed from the machine. Every hour spent managing a tenant or reviewing a lease or driving to a property on a Saturday morning is an hour that didn't go to the life. Leonard was quietly enjoying the one where weekends belonged to him and money was something that happened automatically in the background. And every unit of attention spent evaluating, managing, worrying about, and recovering from a new venture is attention removed from the calm that lets the system run untouched. Russell wasn't just losing money on these ventures. He was losing the psychological stillness that made Leonard's system possible. He was trading peace of mind for activity. And activity in wealth building is almost always more expensive than stillness. This is the habit most people get wrong. We are trained by business culture, by media, by the mythology of entrepreneurship to believe that wealth comes from seizing opportunities, from being bold, from taking calculated risks. And for some people, that's true. Founders, entrepreneurs, speculators. But for the quiet millionaires, the ones earning regular salaries in regular buildings, wealth doesn't come from saying yes to the right thing. It comes from saying no to everything that isn't the system. Russell made 14 major financial decisions in 22 years. Leonard made one, the same one, 264 times. There's something about these 7 habits that becomes visible only when you lay them side by side. Individually, each one looks like a limitation. He didn't earn more, that sounds like underachievement. He never upgraded his lifestyle, that sounds like deprivation. He looked ordinary, that sounds like he couldn't afford otherwise. He didn't talk about money, that sounds like embarrassment. He automated everything, that sounds lazy. He said no to every opportunity, that sounds fearful. He made the same decision for 22 years, that sounds boring. From the outside, every single one looks like a deficiency. Something missing. Something he didn't do. From the inside, from the balance sheet, from the account that crossed $1 million in year 19 without a single phone call to celebrate every single one, is a structural advantage. That's the paradox. And it's the reason quiet millionaires stay quiet. Because the moment you explain what you're doing, it doesn't sound impressive. It doesn't sound like a strategy. It sounds like the absence of action. And that's exactly what it is. Leonard didn't build $1,400,000 by doing something extraordinary. He built it by systematically removing every behavior that destroys wealth and then doing nothing for 22 years. Think about that for a moment. The thing that made him a millionaire was not a thing he did. It was a collection of things he stopped doing. He stopped chasing raises for their own sake. He stopped upgrading when the money appeared. He stopped looking like he had more. He stopped talking about what he was building. He stopped watching the machine. He stopped saying yes when someone else had an idea. He stopped changing the plan. 7 subtractions, that's it. The chasing, the upgrading, the signaling, the talking, the watching, the opportunity hunting, the strategy switching. These aren't neutral behaviors. They aren't signs of engagement or intelligence or ambition. They are wealth destruction behaviors dressed up as financial responsibility. Russell performed all of them with good intentions, with real effort, with the genuine belief that he was being more responsible than someone who just sat still. And he arrived at 62 with $91,000 and a question he didn't know how to answer. You probably already practiced 2 or 3 of these habits. Maybe you automated your savings years ago. Maybe you've never cared about signaling wealth. Maybe you've always been the quiet one when money comes up at dinner. The question isn't whether you know these habits exist, it's whether all 7 are operating at the same time. Because the system doesn't work in parts, it works as architecture. Remove 1 wall, and the structure still stands. Remove 3, and it starts to lean. Remove 5, and you're Russell working hard, trying hard, doing everything that looks right, and arriving somewhere that doesn't feel right. Leonard's walls were all in place. Every single one. For 22 years, and not a single person in that conference room ever suspected a thing. The conference room is empty now. The banner is still up. Someone left a piece of cake on the counter next to the coffee machine that nobody will clean till Monday. Russell drives home and opens his laptop. He types, how to make $91,000 last in retirement. He reads 3 articles. He bookmarks 2 of them. He closes the laptop and sits in the kitchen for a while. On Monday morning, he'll call a financial advisor for the 5th time in 3 years. Leonard drives home and does nothing different. The automatic transfer will execute on the 15th of the month, same as it has for 264 months. He doesn't check the balance. He doesn't calculate. He doesn't call anyone. He never has. 20 years in the same building, same salary, same title, same parking lot, same break room, same fluorescent lights buzzing above the same sheet cake. The difference was never a decision anyone could see, and that was the whole point. 7 habits. Not one required talent. Not one required a high salary. Not one required timing, luck, connections, or courage. They required one thing: the willingness to be boring, the willingness to be invisible, the willingness to be the person in the room that nobody suspects because there was never anything to suspect. And here's the part that matters to you right now. You don't need to start at 25 for this to work. You don't need to go back and undo decisions you've already made. You need the 7 walls in place from this point forward. The system doesn't care when it starts. It cares that it doesn't stop. The most powerful wealth building system available to anyone earning a regular salary in America isn't a strategy. It's the quiet, systematic removal of every behavior that feels like progress but functions as friction. Leonard removed the friction. Russell, with the best of intentions, with real effort, with every appearance of doing things right, added it, one reasonable decision at a time. And the difference was always quiet. If this changed how you think about the distance between what you earn and what you keep, subscribe. The next video looks at what happens when a system like this crosses a threshold that turns retirement from a question into a fact.